A financial year is a continuous cycle of operations, capital allocation, and risk. But to truly measure a company's momentum, we have to stop the clock and isolate a specific, smaller window of time. In corporate accounting, this is an interim period. Any financial reporting timeframe shorter than a full fiscal year. E5 does not mandate which entities must publish these reports, nor does it dictate how frequently they should be released. Instead, AS25 provides the strict architectural framework for preparation. If an entity elects to publish an interim report, or a regulator requires it, they must comply with these precise rules. Stakeholders, investors, lenders, and creditors rely on these mid-year disclosures. They require timely data to assess an enterprise's immediate capacity to generate cash flow and maintain liquidity. Preparing an interim report is not a matter of taking annual data and dividing it by 4. It requires an entirely distinct methodology. AS25 resolves the tension between the market's demand for rapid, high-frequency data and the necessity for rigorous, unmanipulated accounting standards. An annual report is exhaustive, heavily weighted with detailed disclosures and historical context. An interim report strips away that bulk to deliver targeted, efficient data. Entities have the option to publish a complete set of financial statements, identical in scope to their annual filings. However, AS25 specifically outlines the minimum requirements for what are known as condensed statements. The goal of condensed statements is velocity. They focus on new activities and events, intentionally avoiding the duplication of previously reported historical information. To maintain structural consistency, AS25 requires that these condensed statements include every single heading and subheading present in the entity's most recent annual financial statements. There is also a firm requirement for profitability metrics. If the enterprise presents basic and diluted earnings per share in its annual report, it must display those exact EPS figures directly on the face of the interim statement of profit and loss. Finally, the report must include selected explanatory notes. These notes bypass routine operations to highlight material events, shifts in accounting policies, the seasonality of operations, or major debt restructuring. This condensed framework ensures stakeholders are presented with a clear view of new material activities, eliminating the noise of repetition without hiding critical structural changes within the business. Interim figures mean very little in isolation. To provide context, AS25 requires current interim data to be measured against specific historical time horizons. The rules vary by statement. For the balance sheet, the company must compare the end of the current interim period directly against the end of the immediately preceding financial year. The statement of profit and loss requires a dual perspective. It must present figures for the current interim period and cumulatively for the current year to date. Those figures are then matched against the comparable interim period and the comparable year to date from the immediately preceding financial year. The cash flow statement takes a broader view, comparing the cumulative current year to date directly against the comparable year to date of the preceding year. There is one transitional allowance. When an enterprise presents an interim financial report according to AS25 for the first time, they are exempt from providing comparative P&L or cash flow statements for the prior year. This strict comparative matrix forces consistency. It prevents companies from cherry-picking favorable historical baselines to project an artificial narrative of growth. Beyond the visual architecture of the disclosures lies the engine of the report, the specific measurement principles that dictate the numbers themselves. The first constraint is materiality. AS25 mandates that materiality decisions, whether to recognize, measure, or disclose an item, must be assessed based entirely on the interim period financial data, not on projected annual figures. Interim measurements inherently rely on estimates to a greater degree than annual reports. Because the time window is shorter, assessing materiality against this smaller dataset ensures the resulting figures remain understandable and precise. This establishes the core rule of measurement. An enterprise must apply the exact same accounting policies in its interim report as it does in its annual report. To achieve this without distorting the data, measurements are calculated on a year-to-date basis, utilizing only the information available at the exact time the interim statements are being prepared. AS25 treats the interim period as a structurally independent financial window that still strictly obeys the annual corporate rulebook. A persistent issue in quarterly reporting is the attempt to smooth earnings. Companies often try to defer regular costs into later quarters to match seasonal spikes in revenue. Consider the case of Intelligent Corporation, an enterprise with highly seasonal sales. Their quarterly revenue split is 15% in Q1 and Q2, a massive 50% spike in Q3, and 25% in Q4. Meanwhile, their administrative expenses remain entirely uniform throughout the year. The corporation argues that because Q3 generates the bulk of their revenue, they should defer a portion of their Q1 administrative expenses into the third quarter. AS25 explicitly forbids this. The standard dictates that income and expenses must be recognized strictly when they are earned and incurred. Costs can only be anticipated or deferred in an interim period if it would also be appropriate to do so at the end of the full financial year. Uniform expenses must be recognized evenly. There is, however, one major exception to this chronological strictness: income tax. Because tax rates apply to annual earnings, tax expense is recognized in each interim period based on the best estimate of the weighted average annual effective income tax rate expected for the entire financial year. By blocking artificial deferrals for standard expenses, AS25 forces an accurate real-time display of an interim quarter's true cost burden, immune to the distortions of seasonal business cycles. When raw corporate data is filtered through the AS25 framework, the result is a highly specific, standardized document. First, the enterprise selects between a complete or condensed format, locking in all mandatory headings and subheadings from their annual filings. Second, they subject their balance sheet, profit and loss, and cash flow statements to the precise comparative matrix, anchoring current data against strict historical benchmarks. Third, transactions are measured exactly as they occur. The standard enforces year-to-date accuracy and rejects the deferral fallacy. Fourth, explanatory notes are drafted exclusively to detail material, non-duplicated events that have shaped the interim period. Financial markets move relentlessly. Stakeholders demand rapid insights into a company's performance, but speed without accuracy introduces systemic risk. AS25 delivers on both fronts. It provides an unvarnished, mathematically sound view into real-time financial health, totally stripped of narrative manipulation.